Up traders, welcome to this week's episode of the Weekly Watchlist. I'm coming at you from the mobile command center, so the screen will look slightly different, and we're focusing on just the S&P 500 today. We may or may not be live tomorrow at 8:30. So what do we see on the weekly time frame chart? Certainly in terms of structure, a large-bodied red bar with a little bit of upper wick there indicating the sellers stepped up and sold off any of that little rally that we saw mainly on the Thursday session. And of course, a characteristic of this bar is that we closed weak at the lows, indicating that the sellers do firmly have control from that structural perspective. From the location standpoint, obviously on the bar-to-bar count, we have a big lower high and a big lower low. It's hard to argue anything other than that being completely bearish as well. Something interesting here is that we've closed underneath our critical pivot point, which was the prior high that we had been discussing around 415.35. We've known about that level on the daily time frame for quite a bit, and obviously you can see that we did close underneath that. Another bearish implication here is the complete lack of the weekly gap fill. Now, whenever we have a weekly gap, it's very rare that those are left unfilled by the market. Again, the market doesn't ever have to fill a gap, but usually they do tend to fill over the course of the week's trading activity. Continuing along to another slide here, this is the volume profile, of course, and this is starting from the sickness lows over here on the left-hand side of the screen. The high volume node that we've been tracking for quite some time was this one right up here. We've put a line across where that is. Again, that's 415.35, and obviously we've closed underneath this weekly high volume node. We are inside of the low volume node, and remembering that markets like to move from high volume node to high volume node, you can see that it would be reasonable to expect the next support from a volume perspective would be the shelf around 390.45. So be aware of that to the downside. The last thing I would point out here from the weekly perspective is the Fibonacci analysis. Remember that we had discussed in last week's episode that yes, we did get an inverted hammer that printed right off the weekly 50 SMA, and we knew that, in a picture perfect world, 415 would have been that support, but rarely does the market give us a picture perfect scenario. So instead, we sort of were advocates for the 38.2 being the next critical area of support on the weekly time frame, and you can currently see that we've literally closed right on it from the Fibonacci perspective here on the weekly. So do be aware that we're right on the brink of turning this into something more aggressive than just a reasonable pullback from the SPY weekly perspective. Let's drill on down to the daily time frame here. I've got some expected moves loaded up on the chart for us. Let's talk about last week first. Of course, here is the expected move. Obviously, we absolutely smashed it to the downside. On the Monday session, we gapped down and, not really rallied, but fell off into the lower edge of the weekly expected move, which is a pretty dangerous thing to do, right? Because we know that if we breach the lower edge of the expected move, it opens up the door for dynamic hedging and gamma squeeze that, of course, happened on Friday. But at first, we did kind of hold in sideways there. Ultimately, everybody knows how Friday went. Big nasty day, close weak on the lows, well outside of a 2 sigma move there. So going forward, what can we expect this upcoming week? I'm pretty concerned about this. Really, what we look at with the expected move is what is the likelihood that the trend will be sustained on the daily time frame? And here you can currently see that from here to here, we certainly have a lower high, and this weekly expected range that's been priced in by the options market would suggest that we're in store for another lower high, if not just a big lower low. So this is starting to become certainly concerning from the SPY daily trend perspective. Do be aware of that into this upcoming week. Just to give you the numbers, the upper edge is 416.12, the bottom edge is 394.54. Moving through our slides, again, I want to point out the partial gap fill from the Monday gap down. All this would tell us is that the buyers did not, quote unquote, do their job. Remember that when we have thin structure, we're expecting that the opposite side of the trade should be able to move through that area with very little resistance. Why was it that on Thursday we couldn't make that full completion through the gap area? And on Friday, obviously, we know it was the end of that little squeeze to the upside. So a couple of psychological takeaways here. Again, Monday partial gap fill, that's a bearish implication. Buyers should have been stronger there. Friday, obviously, we have this nasty bearish engulfer that took back all of this slight progress we made on the short squeeze on Thursday. Shorts, basically, who were short in the hole at the lows from Tuesday, Wednesday, got bailed out, right? So I would imagine that sellers are feeling emboldened here, that we can potentially see some rotation to the downside now that this has really panned out for them. No longer is there the possibility that these shorts can get squeezed out of the market. That already happened on Thursday, and there was just utterly lack of follow through on Friday, of course. So I would imagine that sellers do have the upper hand here from a psychology perspective, and longs obviously this is a pretty panic-ish type sell side move that we saw. It's not really like many people are going to be the first ones out there to stick their neck out and try to catch this falling knife. Anyways, next up, what do we have for levels to apply to this upcoming week's worth of trade? A couple of critical ones that I really want you to pay attention to. Of course, our line in the sand to the downside. Let's just start with that one first. It is outside of the weekly expected move, but this is a must hold, no questions about it level, 390.85. And of course, we're talking about downside first because of the actions that took place on Friday. So 390.85 is a must hold. Again, it is outside of the weekly expected move. I wouldn't, it wouldn't be my first thought that the market just falls there immediately, but now that we've experienced a 2 sigma move outside of last week's expected move, it is possible that we do start breaching the expected move more frequently as opposed to less frequently. Usually when you breach the expected move, it tends to happen in sequences, groups of 3 or 4 weeks in a row, and then things cool off just a little bit. So it is certainly a possibility, and I did want to start with that first as being a critical line in the sand. Again, that number is 390.85 on the downside. Before we get there, we've got some support at 402.80, and then the 50 SMA is tying in beautifully with this prior pivot high from right around in here. That's 398.75 roughly, so be aware of that on the downside. That would be my first place to be looking for this upcoming week's worth of trade. To the upside, if we get an oversold rally here, I wouldn't really say that the bulls are taking control back until we get back above 411.80 roughly. If we can get back above the lows of the balance from Tuesday and Wednesday of last week, sure, maybe that changes the story a little bit. It's more than a 50% retracement of the Friday down day, and that might start to shift the tone back to the upside, but anything underneath that 411.80, sellers still firmly in control. It's very possible that we can scout a lower high in that type of environment for trend continuation to the downside now. So we're certainly changing our tone. If you remember in the past couple of episodes, we've been fairly, neutral to still bordering on the edge of bullish. Friday certainly changed things out there in the marketplace. Here is the Fibonacci analysis on the daily time frame, and the difference here between this and the weekly is that on the weekly we started from the low here. On the daily we're starting from this low, the equal low where the rally was kicked off from. What I want to point out is that the 61.8 is coinciding beautifully with the lower edge of the weekly expected move for some confluence there, and that needs to hold. Remember that if we start closing daily bars or any time frame bars when you're using Fibonacci analysis underneath the 61.8 retracement, the odds of making the move to the 100% mark dramatically increase underneath that area. So please do be aware of that. Again, if we're above that, it's also going to keep us above that line in the sand, the 390.85 that we just discussed from a levels perspective as well. Let's get into the hourly time frame just to give you a bit more of a nuanced look at where some of these levels are coming from. So obviously on the breakdown, it was underneath this 411.70, which we just discussed on the other time frame chart there, 411.80, excuse me, the 200 SMA here is that 411.70 green box right here. That's neither here nor there, but that's the upside level that if we go there, I would be scouting for that lower high and trend reversal back to the downside. Some of these downside supports, again, 402.80, it's just a minor support, right? That's not going to save the day if the market's seeing another big thrust to the downside. There is potential that this is a bit of a stronger support around that 398.72, and we of course know that the 390.85 line in the sand is really coming from that daily breakout level from a couple of months ago. So those are the downside levels, and again, nothing really changes until we breach this breakout point and recapture that to the upside for any sort of positive development here on the bullish side of the market. So that's the hourly time frame. Here are some sectors that we'll quickly run through. The XLK obviously poised in a bearish position as well. Even less of a gap fill experience on the Thursday session. Shorts did not squeeze aggressively into that area. Obviously Friday, big breakdown as well, bringing us right into some critical structure. So not a great look here. Again, it's very likely that this, even if it does produce a dead cat bounce off of this prior structure, gives us a lower high, and now the daily trend is down, right? So we've got highs, lower highs. If we get another lower high, again, it's just going to confirm that you can look for a breakdown underneath roughly 139.16 underneath the 50 SMA. The blue line there, just not a great look for continuing to hold a bullish slant here in our marketplace. Next up, we've got the XLV, second heaviest weighted component of the S&P 500. In the past little bit here, we've been discussing the look above and fail that happened right here, the close underneath there, and obviously we did get that next leg lower for the rotation into the bottom end of this range around 127.20. So that does strike me as a bearish takeaway as well, remembering again that this is the second heaviest weighted component of the S&P. It's going to be really, really difficult for the market to rally or get out of this funk if the XLV is not playing nicely and just going sideways or even continuing on lower through some of these ranges that we have on the chart. Certainly this fake break to the upside was the beginning of the sort of end, if you will, to this bullish period in the market. So XLV continues to look bearish and looks like it will provide some downside drag for our marketplace. Next up is the Xlf for financials, of course. Main takeaway here again is a big bearish engulfer on the Friday session. We technically gapped up on the Friday morning and then just everything fell apart. As you know, ironically, it did really start when Jerome Powell got on the mic around 10 o'clock is when the sell side activity did end up hitting the marketplace. Nonetheless, big move underneath and a close, candle close most importantly, underneath that 33.90 level that we had been watching. We were kind of scouting for the higher low here. Things did look really great for the higher low, but now, I mean, obviously you've got the lower high here and a close underneath that critical level, so we have to flip the script and sort of fall back into the bearish category in the financial sector. So the big three really, let's even go big four, XLY, are not looking great. You can see that this has much more of a pattern look to it, the head and shoulders pattern, of course, with a close on Friday firmly underneath that neckline around 162.50. Not a great look. Of course, our next support is really the gap fill closer to 156, or let's just call it 157 for round numbers sake, which of course is also bearish drag for the marketplace. Again, these big four sectors make up over 50% of the S&P 500, so it's going to be really difficult for the market to do something that these are not. Next up, we've got the energy sector. We know that this is a D for defensive sector. This is risk off, and the look is not great. Just a very mild pullback on Friday, whereas everything else was absolutely falling out of the sky, right? So why is it that energy had some relative strength there? Again, just goes to underscore the importance of being aware of your risk off sectors starting to lead a rally. Not really a good look for sustainability in that particular direction. So energy continuing to signal risk off here on the Friday session as well, and not experiencing as much of a pullback. To flip the script on energy and to say that this is acting quote unquote in accordance for finding a better bottom in the S&P 500, I would want to see it underneath roughly 78.50 as a level here. Next up, we've got the utility sector. We're going to leave out some of the lighter weight, not so important sectors like materials, like real estate. But in the utility sector, again, just because this is D for defensive, we did want to cover it. More of an aggressive breakdown on the Friday session, but keep in mind where it is on a relative basis to its all-time highs in the prior pivot high from in here. Still well within the range of flagging and pulling back in this sort of prior all-time high zone, if you will, if you just draw on a rectangle like this. Much more of a bullish looking chart on a location standpoint basis, which of course is not good for finding a higher low in the S&P 500. Let's take a quick look at some of the ratios. I don't have them in a grid here on this particular layout. Again, this is the mobile command station coming at you on a Sunday night, but we've got a move in the XLK underneath the 50 SMA. This no longer is holding up beautifully in what was a little bit of a flag look up here. So that does strike me as being more bearish and not a risk on signal. Next up is the XLV. This is the healthcare ratio. This one has been struggling for quite some time. We know that there's been a different look here with the lower high that was produced and a big lower low underneath what is now a descending 50 SMA there. So, healthcare really may have been the harbinger of this sort of downturn in the market. Not really a good look. And again, there's no signs of improvement currently on that big down day on Friday. Next up, we've got the Xlf Financials Ratio. This one's actually holding up okay, given everything that we've seen thus far. You'll notice that it's really sideways in this range instead of falling apart on the Friday session. And even then, it's kind of been put in, or it's put in already, this V-shaped bottom off of the most recent low of early August, which again is on a relative basis a better look than what we've seen in some of those deteriorations in the XLK and XLV notably. Next up is the XLY Consumer Discretionary Ratio, and again this one looks okay, more along the lines of acceptable like the XLF. There's kind of your flag pattern, right, holding up at these highs instead of breaking back down underneath an upward sloping 50 SMA. So overall, the big four risk on sectors are more neutral as opposed to screaming risk on, with only the consumer discretionary and financial sector kind of playing nicely. Here's the XLE on a relative basis to the SPY, and you'll notice that this is pointing higher, of course, not a great look. We already covered that on the structural chart, and the same thing in the XLU. This pattern, again, it's hard to say anything bearish about that pattern. Sort of an ascending triangle look, looks like it can make a new high here. Not good in terms of finding a risk on bottom in the S&P 500. Next up, these are internals broken into individual components. Again, I don't have the full dashboard in front of us, but here is the volume reads, right? And what I want to point out is obviously the significant outflows on the Friday session underneath our negative 300 million mark. So it's not like this was just long liquidation. This could have potentially been some new money shorts positioning as well. And if you were watching on the intraday on Friday, of course, the selling activity was relentless there with very little give and take, buying and selling. So could new money sellers be entering the market here on confirmation underneath those 3-day lows from Monday, Tuesday, Wednesday? Absolutely looks like it could be the case based on this volume read. Next up, we have our advanced decline line. This is where I do get a little bit concerned for a dead cat bounce early on this upcoming week. You'll notice that we've got an advanced decline line well underneath the negative 2,000 mark, which of course is not sustainable. That's what we saw here Friday and then into Monday of last week. And of course, we neutralized that with a move into the zero line on the Tuesday session. So do be aware that this is kind of what you're watching out for. I can't show you this side by side, but try to picture in your mind, if the SPY opens neutral in the Friday range and the advanced decline line opens around zero, all good. We can continue to experience some sell side activity. That overcorrelation will have been corrected. If we open neutral in the S&P 500 inside of Friday's range, but this is still overly correlated underneath negative 2,000 down here in this zone, that's a red flag where shorts late to the party from either Friday afternoon or early Monday morning session can get squeezed out, and we'll look for a little bit of a rebound to the upside. We're not expecting a major rally, just a little bit of added buying pressure on any sort of dead cat bounce that we experience as these shorts with terrible trade location close out. Here is the last takeaway from the market internals. This is the tick, and this one's kind of a head scratcher for me. I was talking through it with a good friend here. We couldn't make sense of why the tick on the Monday session was way more bearish than what we saw on the Friday session. That to me is not quite making sense. Initially, the takeaway is, okay, fine. It looks like some of the selling pressure is contained to the more aggressive risk on sectors, right? Because we know that they are more heavily concentrated in the SPY. So maybe across the broader marketplace, maybe we weren't seeing as aggressive downward activity, but it wasn't the case. It was bearish almost everywhere in the market on the Friday session. So this to me is not quite adding up. If you've got any insights, I'd love to hear from you down below in the comments section, but still the major takeaway is ultimately that yes, it is confirming the bearish activity that we saw on the Friday session. Here we go with the TNX. This of course is the 10-year interest rate, and we'll notice that it's still going sideways. So it's not like we saw a big spike in interest rates. It's not like J-Powell came out on the Friday session and sent rates up and over, aggressively, that 3.25-ish area, basically the top of this overall range that we've been trading in. So it wasn't rates that impacted tech. It does appear to be just some selling that has hit the market. So either new money sellers off the daily 200 SMA and resistance trendline, or long liquidation, which has started and then attracted new money sellers in terms of spurring that downside leg. So TNX, not overly concerning here, just kind of flattening out around the 3% mark. And we know that stable rates are a good thing for the marketplace. Obviously, if they come down, that should benefit tech, which would mean a better bottom in the S&P 500. But if these just go sideways here, it's not so much going to carry major implications for the S&P 500. What else do we have here? We've got the VIX and the VVIX, and then we're out of here. In the volatility index, certainly a big move higher on the Friday session. Again, we're usually looking at capitulation type bottoms if we get spikes up and over the 35 handle, and it's not the case. I mean, we're definitely perking up, don't get me wrong, but it's not like we saw a move into the 35 handle. So can this selling pressure continue? Can the volatility continue to intensify? Absolutely. And that goes back to what we were saying about the weekly expected move. When you breach one, oftentimes it's more than likely the case that you'll breach a cluster of them in a row instead of just a random one here and a random one there. They tend to happen in little groups, and maybe if that leads to a capitulation type bottom in the S&P 500, we get a VIX print up around this 35 handle. When and if that happens, we will be looking for temporary bottoms based on an exhaustion from the sellers. Last but not least, we've got the VVIX here. This is the volatility of the volatility index, and all I wanted to point out on this one, I don't have the sizzle data for you. Of course, I'm not on Thinkorswim in the mobile command station, but this did perk up big time off of that 85 floor. Granted, we're still underneath that historic 103, but the main takeaway is that as and if this comes into the 103, we are more likely to see that VIX spike into 40, which would lead to the capitulation type bottom. So something to continue to keep an eye on. This would continue to suggest that no one is hedged properly. Therefore, if no one's hedged properly, no one's buying SPY puts, no one's buying VIX calls, it means when and if everyone's rushing to the same place, that's when things spiral out of control, right? And that's still the case here in the VVIX. That is going to wrap up this week's episode of the Weekly Watchlist. This has been brought to you by the Mobile Command Station. If you appreciated the video, don't forget to give it a thumbs up, drop a comment down below, and I wish you all a green trading week.